actually view the virtual conference for you. If you've got audio problems, video problems, I had a few yesterday, but we're powering ahead today. You can refresh those with your browser. I've gone right up the tech curve, everybody. It's pretty amazing. It is interactive. There are questions. There's Q&A the whole way through. Please jump on to the Ask a Question button on the right-hand side and join me with whatever it is that you want to put to my guest. They'll pop up as we go along, and I'll put that to Secretary General in a moment. We also have a hashtag, never a virtual conference or a conference without a hashtag. Hashtag Bloomberg Invest. And really, without any further ado, let me introduce the Secretary General that I've referred to. He is my first guest of the day. It is Wamkele, Mene, Secretary General of the African Continental Free Trade Agreement. Secretary General, welcome to Bloomberg. Welcome to Day 2 of Invest Global. You've got a big job. You've got a lot of African leaders to bring together in the time of crisis of COVID to do a heck of a trade deal. Is the appetite getting stronger to complete the deal, or are people finding excuses? Good day, sir.
Well, thank you very much for inviting me, Manus, and I really appreciate the opportunity to share with you and the viewers our progress in the African Continental Free Trade Area. COVID-19 has been a significant change. We were expecting that from the 1st of July this year, that Africa would start trading under a new trading arrangement, new rules for trade, and we were expecting that Africa would start investing intra-Africa investment and also FDI inflows under a new set of investment rules. But as I say, COVID-19 has been a barrier. 42 countries, 55 in Africa, are either in a full or a partial lockdown. Countries in Africa and governments in Africa quite sensibly and responsibly, in my view, are focusing on saving lives of Africans, which is a critical endeavor to undertake in the face of this pandemic. And so public health, the public health of Africans has become, in the last 3 months, the number one priority, and as I say, correctly so. However, I should state very clearly that the political will remains, the political commitment remains, that when the conditions are conducive, that Africa will be back on track with the African Continental Free Trade Area, and that we will implement the agreement, and we will redouble our efforts in implementing the agreement, because I think unlike many other countries in the world, Africa desperately needs this agreement to be the driver for economic recovery in Africa. We don't have stimulus packages of trillions of dollars. The economic recovery plan for us is to significantly boost intra-Africa trade from 2021 year on year. So the political commitment remains, and the will to do it at the highest level, political level in Africa, remains.
You are, as everybody is, 100% right. The priority for the world is health and lives, but we're going to need this free trade agreement, sir, to generate jobs and hopefully better wealth out the other side. So what is the sticking point, and how narrow is the window to get this done? How big is the risk for us?
Well, the window is very narrow. We had our own timelines, and according to our own timelines, we wanted by the end of this year to be well on track in establishing a new set of rules for trade and investment, and in terms of job creation, that this agreement we hope will create. And so the window is very narrow. We recognize that, which is why we have consulted with the heads of states, and they have told us, and myself as the Secretary General, that we need to move as quickly as possible when the conditions allow And so the direct answer to your question is yes, the window of opportunity is very narrow, but we shall seize it. We shall seize it when the public health conditions enable us to do that. Remember, there are 28 countries that have accepted the legal obligations of this agreement. Out of 55 countries, 28 countries have deposited what we call depositing their instruments of ratification. So they have accepted that this has to be done, this agreement has to be implemented, and they recognize that a fragmented market in Africa, that lack of economies of scale, smallness of national economies, that all of these challenges that Africa has had were in respect of trade, investment, and in general economic development, that all of these challenges, you can attribute them really to lack of an integrated market in Africa. Investors are not interested in being subjected to 55 different sets of regulations, either for telecommunications, financial services. So market fragmentation is something that all of us in Africa recognized. There's been a significant barrier to enhance FDIs into Africa and enhanced investment by Africans in Africa. And so these 28 countries have recognized that we have got to ensure
Secretary
that
General,
we implement this.
Secretary General, can I interrupt you? Secretary General, we've got to pause for thought.
Sure.
We've got to actually pause for thought. We've got a lot to get through. So I'm going to encourage you maybe to be a little bit briefer with the answers. I'm going to ask a poll. So one of the biggest challenges is whether we get a wave 2 or whether we're in a continuation of wave 1, Secretary General. So this is what I'd like to ask our audience. We have a polling question. Will we see significant second waves of COVID-19 during the rest of this year? A, yes, they will be deadly. Expect further lockdowns. No, infections will steadily decline. And C, the virus will remain, but there won't be a second wave. Now, of course, it depends who you talk to, Secretary General, because some people would say we are very firmly in wave 1, as Africa is, and we haven't even begun to really understand what wave 2 is. So the numbers are coming in there at the moment. We'll come back to that in just 1 second. I was trying to get from you, and I want a brief answer on this, sir. What is the biggest sticking point on getting this, everybody agreed? Briefly answer that, then we'll revert to the poll, sir.
Well, the biggest sticking point in any trade agreement is countries have national interests. And so the objective is to make sure that there is a convergence, that you can agree on the negotiating table. Remember, we have 55 different countries. So 55 different national economic objectives have to be reconciled. And so this is the critical challenge, not just in this negotiation, but in all negotiations, certainly that I've been involved in.
So then let me ask you then, why has Nigeria and Tanzania not signed off? You talk about the political will is there, the ambition is there, your window is small. What is holding Nigeria and Tanzania back? If you had to encapsulate that, what is that?
As I said, there are countries that have specific national concerns. What we understand is that Nigeria is worried about the possibility of transshipment, that is goods coming in from countries outside of the AFCFTA region. Tanzania has similar concerns. And so we have got to address this concern of the possibility of transshipment because it leads to job losses. If you get a shirt, you put a button on it, you're bringing it from another country, you put a button on it and you say made in country A, that is not the type of activity that we want to see being created by this agreement. We want this agreement to foster industrial development in Africa. And so we share Nigeria's concerns. We've got to find ways of reassuring, not just Nigeria, by the way, reassuring all countries that we will deal with the challenge of transshipment of goods.
Look, the whole issue of the additional fiscal pressure that nobody in the world, in America, the United Kingdom, or Europe anticipated. The whole additional fiscal pressure for developed markets is one thing, but this fiscal pressure on your nations, your collective, is even more overwhelming. Does that reduce the desire to deal with the hard tariffs that need to be dealt with? Has that been pushed back?
Well, we have to deal with the fiscal challenge that comes with the reduction of tariffs, of duties. That is the whole point of the free trade agreement. Intra-Africa trade is only at 18%, largely because of high tariffs amongst African countries. So you cannot have a free trade area. You cannot boost intra-Africa trade with high tariffs. You've got to reduce the tariffs and reduce the regulatory barriers at the same time. There will be short-term adjustment revenue challenges that countries will experience rather. Mm-hmm. And I'm very happy to announce that in this regard, Afreximbank has made a commitment of a substantial amount of funds to assist countries who are going through adjustment challenges as a result of revenue forgone because of reduced duties or eliminated duties in some cases. And I believe that adjustment facility will be the cushion which has been provided by Afreximbank, is the cushion that countries so desperately require. And we intend that this adjustment facility should be directed to productive sectors where you are experiencing specific challenges as an economy.
I just want to reflect back. We put the polling results up, Secretary General, so I just want to reflect on that for a moment. You talk about various things about trying to smooth out this. So let's just reflect on this. Are we going to see a second wave in the rest of the year, was the poll question. As I look across the screen, we've got, it's a 50% believe that the viruses will remain and there won't be a second wave. So the virus will remain almost like in perpetuity. It's like an underlying issue for us. No infections will steadily decline. Only 4% believe that scenario, but a hefty minority believe that yes, there's going to be a deadly second wave and expecting further lockdowns, 44%. Sir, you and I could spend the next 2 hours debating whether we're in wave 1, wave 2. Please forgive me. We don't have that time. We are in the eye of a crisis. If this re-escalates again, do you fear the worst case scenario is this deal gets pushed out into 21?
No, I think that when you look at Africa's response to the crisis, you look at how rapidly we developed a coordinated approach, which was led by the African Centers for Disease Control and Prevention, a coordinated approach throughout the continent, the lockdown measures, introduction of public health protocols across the African continent. I think we have been we managed it with a high degree of success. Of course, we come from experience having dealt with other infectious diseases before. I think our level of preparedness places us in good stead, so that if there is a second wave, or if the pandemic continues into 2021, we will develop the necessary public health protocols to continue and to push on with the implementation of the AFCFTA. Because as I said earlier, this is our only stimulus package. So my view is that, of course, we will take advice from public health experts, but we will, now that we know the pandemic and we know its nature and its character, we will have to take advice from public health experts whilst we continue the work of implementing the AFCFTA and reigniting growth in Africa's economy again.
Okay, I want to get through a couple of questions. So if we can just sort of very quick responses on these, it allows you and I to get through some other issues. I know we want to talk about the private sector and how they can help in this scenario. So just some very quick sort of rapid fire response here, Secretary General. Kevin from Nigeria, I think this is his pet subject. He was with me yesterday when we had the EcoBank CEO, but he's back again. And he's talking about turbulence, turbulence in the bond market and emerging markets, especially in Africa. Now, you You and I have touched on this. You talked about the scale of financing that's going to be necessary to smooth the transition. So my question to you is, do you expect, translating from what Kevin has said, much more bond issuance in emerging markets and in Africa? Do you think the world is ready for that?
Well, I certainly hope so, because Africa is taking active steps to ensure that from a regulatory point of view, that there are legal protections that are provided. We are going to have in the agreement itself, we are going to have an investment chapter that will cover a range of investment activity, including FDI inflows into Africa, including portfolio investment, including intellectual property rights, including physical investment. And so I hope that having laid the legal foundation through this agreement and the regulatory protections for investors, both African and foreign investors, I hope that investors will find that sufficiently attractive to resume their portfolio investments into Africa.
What do you think the biggest blockage is to private capital coming to Africa? For many, many years when I would do these kind of conferences, people would talk to me, it's about governance, Manus. It's about governance and good governance and corruption, or reducing corruption. When I chatted to you last week, you said, Manus, actually corruption is no longer the dominant theme. So if it's not, or where does it feature? But what is the biggest obstacle to FDI? Is it governance and regulation? And is that what the essence of this this free trade agreement has got to give global investors to bring money to Africa?
That is precisely at the heart of our objective. When I talk to investors, big and small investors, African and non-African investors, what is there as a barrier to enhance investment in Africa is, one, the market fragmentation, lack of harmonization of rules for investment and trade. And then, of course, the second issue that is consistently raised is the lack of enforcement. Whether you're talking about enforcement of a contract at a national level or sub-regional level, enforcement of protection, investment protections. These are the number two areas that I consistently hear from investors. And so we hope that this agreement, once all countries, and I believe all 65 countries will eventually be on board, the fact that we have a harmonized set of regulations, it should make investment easier. It should make it should improve Africa's doing business index, and certainly it should enhance our investor climate. So this is absolutely our objective.
Okay. So, and look, you're probably the perfect captain to ask this question to and to give our audience a sense. There's these cliches, aren't there, in the market about Africa, China, that symbiotic relationship, that mutual relationship, but some would say there's an over-reliance by African nations in reaching out to Africa. What do you say to that, or what has been the conversations around that when you talk about doing the free trade agreement? Is that part of the narrative about where China fits into what they've done and what they will do in the future, and why you do this free trade agreement?
Well, China has always been a partner on development, economic development with Africa. But the free trade agreement has to place Africa on a path of self-reliance and self-sufficiency in terms of production structures, manufacturing. I think what this crisis has underscored as a fundamental weakness for Africa is our very, very shallow industrial base and our very, very shallow manufacturing capacity. So we've got to establish a manufacturing capacity and regional value chains that will place Africa on a path to value-added production. Not for us to completely disconnect ourselves from global value chain, because I don't think that any country wants that. It would not be in our interest. We cannot disconnect completely from global value chains. But at the same time, this crisis has exposed that over-reliance on a single supply route is not good for Africa. And it also has exposed that over-reliance on the supply or export of primary commodities is also not good for Africa. And so I think this is a challenge, but it is also an opportunity. It's a crisis, but it's an opportunity for Africa to really accelerate our industrial development objectives and to really accelerate our digital trade and digitization of our trade to take account of e-commerce and activity that is already happening on the African continent, albeit, of course,
do you think that as a result of COVID and in a post-COVID world, that digitization is going to accelerate this? This is one of the themes. Everybody talks about technology. I'd like you to make the technology piece come alive for me within this free trade agreement, and whether that accelerates.
When I was in the campaign mode for this position, one of the pillars of my vision was digitization in Africa. And not just e-commerce, but digitization is a broader concept than e-commerce. We know, for example, that if you go to Kigali or Lagos, you will find young Africans who are innovators in e-enabled platforms for commerce. We know that it is already happening in Africa. We know that also for financial technology, there are centers of excellence in Africa. So my role is to make sure that we establish the regulatory frameworks for this to happen in a pan-African sense, the regulatory framework that will accommodate all of this innovation that we are seeing in digital trade across the world. You take, for example, now because of COVID-19, now we know that you can, because of e-commerce, you can access your doctor remotely. We know that you can access a pharmacy remotely. So there's a range of technologies through e-commerce that have an innovation that has come out on the back of COVID-19. But we've got to make sure that as Africa, we focus on small, medium enterprises in digital trade, on multinational corporations, and ask ourselves, how do we codify into a legal instrument that provides market access all of this digital innovation to make trade more efficient in Africa? Whether we're talking about the small, medium enterprise or the subsistence farmer in Lake Victoria, who actually uses technology to access markets across the border. So I think
who's driving the free trade agreement? Just when you paint that picture, would you paint that image to me of the farmer in the field using technology to sort of jump the Rubicon? You're having conversations with huge organizations who want to drive investment into Africa, and you're trying to balance that with a small man or woman in the field. So let's take it to those that have got the capital, which is the large. So what are those conversations? Which sectors are those conversations with, and what are they asking you for?
Well, there has been an initial interest that has been expressed on, particularly on e-commerce. In fact, as recent as last week, a major IT company expressed interest. But the concerns that potential investors, whether it's financial technology, mobile banking, all digital platforms, the main concern they express is the issue of data sovereignty and the issue of restrictions on the movement of data storage, and whether or not if you invest in a particular jurisdiction and you establish a data center, which requires a significant amount of capital, you need to be able to move your data. And so these are some of the conversations that we will have with potential investors, because we believe that Africa has a competitive advantage, and we would have, of course, consider issues such as national security, in the movement of data. But certainly, when you look at the fact that in South Africa, in Kenya, in Nigeria, Microsoft, Google, Amazon, they've all invested. The last one to enter the South African market was Amazon, who invested in a significant data storage center. So the regulatory framework
Yes.
has got to be appropriate.
What is the risk? And I'm paraphrasing from another question that's come in across the platform. And it says, look, we saw divorce in Europe 3 years ago, Brexit divorce. You have the North-South European anxiety playing out to the fore at the moment in the stimulus response to COVID. So you've Brexit, you've Brexit, you have the frugals. So you have this divide, this very clear divide. There are those with the money and the capital and the power to drive the union and those to rip it apart. Are you seeing those kind of power plays delay this free trade agreement?
Well, it depends how we approach its implementation. For example, if we focus only on African multinational corporations as the sole beneficiary of this agreement, it's not going to succeed. If we focus only on the already developed African countries, on the African countries that already have an industrial base, South Africa, Morocco, Kenya, Egypt, and so on, it's not going to succeed. So we've got to learn from precisely those countries and those regions that we've mentioned, where globalization was rejected, where trade agreements were rejected, because populations felt that globalization and agreements are not benefiting very important segments of society. You will recall that earlier I mentioned women in trade. I mentioned informal small medium enterprises, young Africans in trade. If we don't bring in the fold, as we implement this agreement, if we don't bring these important segments of society with us, it's not going to succeed, I'm afraid. And we may have exactly the same situation that happened in many, many countries, where the rejection of globalization, the rejection of free trade agreements led to the rise of right-wing, fundamentalist, chauvinist governments who are leveraging on this rejection of globalization. So we've got to make sure that there is inclusive growth as we implement this agreement.
Well, there's certainly that pushback, isn't there, from a whole variety of nations towards unilateralism, close up borders, and very much perhaps become more insular. Secretary General, can we circle back to where you and I began the conversation, which is about COVID and health, the risks to your free trade agreement materially. But more importantly, I want to get a sense from you, the battle between government and health. In other words, governments will be placed under more and more economic pressure to reopen, perhaps more quickly than the health scenarios suggest. Is that a real risk? And if so, how dangerous is that? That's a question from the audience.
Well, there is a great deal of risk that from a public health point of view, there will be extreme pressure to maintain either whether it's borders closed or to be inward looking. I think there is that risk, but I think we must remember that we as Africans, we know that it's very, very important for us to have an integrated market, particularly in services. You take, for example, the fact that the largest contributor to Africa's GDP is the services sector, hospitality, the airline industry, and the projected declines in the services sector this year because of COVID-19 is up to $30 billion. So we cannot, we can't keep our economies closed for extended periods. What we have to do is to ensure that we take advice of public health experts. We put in place the the public health protocols, but at the same time, commensurate with the country's crisis, we open our borders for trade. We start implementing the agreement. We start traveling on the continent so that we get Africa back on track in terms of economic growth. But, of course, I want to emphasize really taking into account the adhering to public health experts and the protocols that have to be put in place. A lot of countries are announcing in Africa, for example, ECOWAS by the end of July will open borders and put in place health protocols. Many other regions in Africa will do the same because we all recognize you've got to balance economic activity with the importance of maintaining high standards of public health.
Indeed. Secretary General, we wish you well. Thank you very much for giving us the time, frank discussion, and answering the questions. I wish you well on your trip. I wish you well on your free trade agreement. And I look forward to seeing you in person, either here when the flights restart, or indeed on my trip to Africa. Secretary General Wamkele, thank you so much for being with us today on Bloomberg. So that wraps up our day two, our interview. Our very great thanks to Wamkele Mene, the Secretary General. We're going to hear from the Bloomberg intelligence team. They produce some phenomenal research, which I use on a daily basis. So today we've got Stephen Chu, Hugh Worthington, and Damien Sassover. And the topic today is gauging the rebound in global credit and rates.
Hi, I'm Stephen Chu, the Asia FX and Rate Strategist at Bloomberg Intelligence. We will discuss why we are positive about the Chinese yuan and the Chinese government bonds in the post-COVID world. Firstly, with the Fed printing trillions of dollars to battle the pandemic crisis, we believe by now the dollar credit or dollar equities may deem to be less appealing to some foreign investors. And the search for yield behavior may render capital to eventually flow back to the EM markets, especially EM Asia. Asia may be ahead of the rest of the world in virus containment and macro recovery, and their respective equities and bonds should have alert to the foreign investors, we believe. In fact, the Asia capital outflow momentum on a 90-day rolling basis has been slowing as inflows start coming back in recent weeks. Within Asia, one obvious destination will be the Chinese yuan assets, especially China bonds. China has less urgency to normalize monetary easing even in the post-COVID world, as the PBOC did refrain from bold rate cuts or triple R cuts earlier this year. At the moment, the 10-year China government bond yield is over 200 basis points above the US Treasury yield, and even 50 basis points above with a FX hedge basis. While other EM Asia bonds may offer higher yields, their currencies are more volatile and come with pricier FX hedging costs. Now, in fact, FX hedging may not be necessary as the yuan itself has long-term appreciation potential. With the US dollar facing a structural downtrend in the second half of the year due to the Fed's heavy printing, the yuan itself has headroom because its role as a reserve currency could thrive from here. Foreign investors, especially the central banks and sovereign wealth funds, may further diversify their research into the yuan and China bonds, we believe. Finally, China's bond curve might have bear flattened too much since May, according to our positioning analysis. Here we look at the heat map of Z scores of various spread buckets of the China bond curve, and we found that the spread with the 3-year as the front rate has bear flattened too much. In fact, the 3-year 10-year spread has flattened all the way from above 110 basis points, which by the way was the steepest since 2010, to below 50 basis points right now. The reason was that PBOC disappointed market with the lack of monetary easing over the last few weeks. But that makes sense because PBOC really didn't go for bold easing at the beginning of the crisis. So all being said, we think now could be a good window for boost steepening in the China bond curve again. And the bondholders may prefer to stay in shorter duration, in our view. Thank you. For more information, you can find us at Bloomberg Intelligence on Bloomberg.com.
Hi, I'm Hugh Worthington. I cover European rates and government bond research at Bloomberg, and I have done since October 2018. And I'm going to talk to you a little bit about the European government's response to the coronavirus crisis. Well, if you look at this chart here, it probably shows you some of the issues that we've got. The response to the crisis is very similar in Europe as it's been elsewhere. There's been an enormous cost of funding the various programs that are being put in place to fund the recovery from the virus and the response to it. So net debt issuance in Europe has gone from something like 170 to 200 billion euros expected at the start of the year to around €1 trillion currently. And that's got to be taken down by somebody. Now, in the past, the ECB has not been keen to engage in QE early on when we had crises. And in March, the ECB almost dropped the ball again. They said they were not here to close spreads. And we saw very quickly a very rapid deterioration in funding conditions for Italy and Spain in particular, to the extent that people are probably getting concerned about their ability to fund their response to the crisis. So the response was very quickly. They came in with a new QE program this time, the Pandemic Emergency Program, 750 billion euros at first, and then more latterly raised to 1.35 trillion euros. Now that basically means that the net issuance has been taken down completely for this year. And in fact, the funding situation as we are now, in the second half of the year, around 300 billion euros of bonds will need to be sold to the QE program. So the funding conditions look pretty good for this year. But the ability to depress yields is very key. The credit rating agencies are very, very aware of the fact that a lot of countries, in particular Italy, debt burden is going through the roof and not probably sustainable in terms of keeping it within an investment grade rating. And then we can get concerned about things like what might happen in terms of forced liquidations by foreigners in particular. So for now, I think things look okay, but the concern, as I say, is much longer term, that next year when the QE support falls away and those debt burdens have gone up and up and up, the rating agencies may well look to start to act again, and you could see pressure on those yields. Now, there's a response hopefully put in place that the signs that there's been some better EU-wide approach to the crisis. But it's not debt mutualization. There are some grants, but they're very small and they're taking a long time to come through, only about 4 or 5 billion next year. So it may well be that the burden is going to stay very much on the ECB, and they are going to have to do more and possibly faster, and the support will have to stay in place throughout the whole of next year to keep yields and spreads under control here. That's all for us. Thank you very much.
The coronavirus pandemic is enlarging sovereign debt loads and fueling local demand for dollars, aggregating fiscal imbalances and exposing emerging market investors to greater risk. Good afternoon. My name is Damian Sassower. I'm the Chief Emerging Market Fixed Income Strategist for Bloomberg Intelligence. And for the purpose of this presentation, I think it's instructive to see just how far we've come since mid-March, when EM dollar and local currency investors were grappling with losses on the order of 13% and 15% respectively. In slide 1, we break down total returns for the EM US dollar aggregate bond index into its constituent parts. And what you find is that the positive returns from carry, which is coupon income, and duration, which are movements attributed to shifts in the US yield curve, fail to overcome the losses we're witnessing from spread-related factors. And so Latin America obviously is weighing from a spread perspective on most returns year to date, with Brazil standing out, Mexico standing out, and of course Argentina down 19% year to date, standing out in the eyes of investors. Slide 2, we do the same thing for EM local currency bonds. And what we find here is that, again, the returns attributed to carry, which is coupon income, and duration, which is attributed to movements in the local currency bond curves for each of the 20 countries in the index, fail to overcome the negative performance we've seen from FX, from currency losses. And so here, what you find is that it's the high beta currency crosses, specifically those in Brazil, Mexico, Russia, South Africa, that have really weighed on returns year to date. And with the index down roughly 4% today relative to down 50% back in mid-March, we can really see just how far we've come on the currency side and whether or not those gains are going to hold for investors. So what is driving some of the gains we've seen across emerging markets? Well, it's the extraordinary central bank stimulus both across developed markets, but more importantly across emerging markets, which are really pulling yields down and driving up the valuations of the underlying debt. And so we've seen roughly or more than 5,000 basis points in central bank rate cuts since 2018 across the whole of emerging markets. That's unprecedented, never before seen. And what that's doing is, while it is fueling duration gains, we question just how much capacity many of these central banks have to continue to cut rates going forward. Shifting to slide 4, what we've seen is that with all these rate cuts that we witnessed across both developed and emerging markets, the average yield to worst for the Bloomberg Barclays global aggregate has fallen from 2% at the end of 2018 to 1% today, or just under it, call it 99 basis points. So a rough halving of the yield or the income that investors can expect from investing in a diversified bond portfolio of investment grade debt. And so while that has pulled down EM local currency yields as well on the order of 210 basis points over the period, we do think we're going to see a bit of a rotation, and we are beginning to see that into some of the high yielding emerging markets that are within that index, specifically Indonesia, Mexico, and Russia. Those 3 countries have average yield to worst in excess of 4%. And so while we do expect to see that shift continue, there are still risks prevalent across the EM marketplace, and the concerns that are growing amongst the eyes of investors as we approach the zero lower bound in the US are not going away anytime soon. Thank you for your time.
Some pretty staggering numbers there from Damien. 5,000 basis points worth of cuts. Are you prepared to take that risk for 4% yield in Mexico? It's the end of day 2. It's the end of my session from Dubai. I want to thank you, everybody who's tuned in for the discussions, especially to my last guest, the Secretary General of the African Free Trade Agreement. Thanks to our sponsors, EcoBank, and they are our Africa and Middle East partner for making this event possible. Now, stay tuned, because the day rolls on from me. I hand over to Francine and the team in London. We then head on to Alex and the team in New York, and each event begins at 1 p.m. in the local time. And you can see all sessions across the globe. They're archived. They're on your Bloomberg Invest Global Hub. So that's your destination. You got the recap of all the videos there if you didn't pick up everything. Those slates that the guys and girls have just put together from Bloomberg Intelligence, stunning on emerging markets. Bloomberg Intelligence data and resources from our sponsors. Tomorrow, 1 o'clock, I'm back with you again, hopefully in vision and sound. It'll be day 3 and the final day of Invest Global from this part of the world in the Middle East. Follow us at Bloomberg Live on Twitter. We're there. LinkedIn for updates. That's a huge thing for us here in the Middle East. And please be sure that you track our ongoing coverage at business, Bloomberg.com. And if you haven't already, please consider subscribing for a subscription, because we're there. Bloomberg.com subscriptions, a daily subscription, information that you can't trade markets without. This is Bloomberg.